Welcome to our 3D Easter Crash Course for POE. The classes are 4 hours, although it may go on to be a bit more. I am actually going to try for it to be less than 4 hours. I will really genuinely try, but POE is a large syllabus. It may go over, but I will genuinely try my best, right? We're going to start off by covering some of the early topics. Accounting as a profession, accounting as a system, different books of original entry, ledgers and the trial balance. Those are things that you would have done in terms 1 and probably terms 2 in Form 4. And then we're going to look at bank reconciliation, control accounts, and then errors of the suspense account. And remember, this is a crash course, so it won't be as super detailed as you would have done it in class, but we'll be going through the major parts in each of the topics. Right? We're going to start off with accounting as a profession, and you don't have to worry about rushing down notes. This entire PowerPoint, I will send it to you all at the end of the class through the WhatsApp group. That way you'll have access to it to go through it on your own, right? The very first thing you'd have learned in school, or should have learned, was what was accounting. Now, I would expect you to remember this entire definition for word, but try to remember some of the keywords. Recording, analyze, classifying, summarizing, interpreting. Try and remember some of those words, right? And the fact that it's a systematic process. I've seen this question come per paper 1, and the answer repeats some of these exact words. Right? So system of processing, systematic process of recording, classifying, summarizing, analyzing, and interpreting financial information. Another set of words that they normally use, which I don't have here, are words to describe the type of information. And that is relevant, reliable, and comparable. Right? The purpose of accounting yes, is to keep accurate financial records. It's to assess the performance of the business, to comply with legal requirements. But all of these things are done so that the users of financial information can make better decisions. Mm. Financial recording, performance assessments, complying with laws. But the biggest one is to help users make better decisions. Now, when it comes to the users of financial information, they can be put into 2 categories: internal users and external users. Internal users are people who are inside the company, directly involved with the company. External users are people who are outside of the company. They are not directly involved with the company, but they're still interested in the company for some reason. Mm. So, for example, managers, they are part of the company. They would use the information to try and plan and budget. Employees would use the information to see how profitable the business is, so they know if their job is secure or if they have to worry about the job closing down. To see if The company has the ability to pay them, give them bonuses. The owners might use it to see if they're making a profit or not. And then we have external users, people outside the company, like potential investors, people who thinking about if they should invest in a company or not. They want to check the financial information to see if it makes sense investing. Banks. Before a bank lend you money, they want to check your financial information, see if they can pay it back. The government, they want to make sure you're following all the rules and you're paying your taxes. Even customers, although they're the least likely to use your financial information, even customers may want to use your financial information to make decisions. Anybody could think of one other person outside the company that might use the information? Don't be shy.
Stakeholders.
Say that again.
Stakeholders.
So all of these are stakeholders. So you're not wrong. It's just that everybody there is a stakeholder. You ever heard of an external auditor? Anybody ever heard of that before? He's a person who's not part of the company that comes into the company to check the financial information to make sure it shows a true and fair view of the company's actual financial status. So they basically checking to see if you're accounting true, or if you're lying, committing fraud, or making errors. Next thing we look at is the ethical principles in accounting. You all ever saw that before? Ethical principles in accounting?
Yes,
Yeah.
sir.
Yeah? All right. And there's 5 codes of ethics that accountants must follow. These are the 5 right here, and they have been tested in exam before, in paper 2, so it's quite possible for it to come right. That's integrity, objectivity, confidentiality, professional competence, and professional behavior. Integrity, just being honest. Objectivity, don't let bias affect your decision making. Confidentiality, keep private information private. Professional competence, having the ability to carry out your task as an accountant. And then professional behavior, not behaving in a way that makes accountants look bad. You're supposed to know these 5. If you don't as yet, you have some time trying to learn them before the exam. You also need to know some illegal issues in accounting. Things that could get you arrested. You should know about money laundering. Money laundering is taking money that you get from illegal means and passing it through the accounts of a business to make it seem as if it came from the business. So I selling drugs. I make $10,000 from selling drugs. I open a car wash company. Although I only wash 10 cars, I record that I wash 100 cars. And I take the money from my drugs and put it in the car wash company and make it seem as if I get it from washing cars. That's money laundering. Tax evasion is using illegal means to avoid paying tax. So I make a set of money. I decide to open a bank account in Switzerland and put my money there to try and hide it from the government. There's also fraud. So I could do my accounting to make it look as if my business is making more money than it actually is, to try to attract investors. Very illegal. And these things can bring consequences, right? It could have simple consequences like the you hurt your reputation, less people want to buy from you now, to larger ones like jail time, fines they had to pay the government. Long story short, don't do anything illegal now, please. Now with it. Last but not least, careers in the field of accounting. If you become an accountant, there's certain careers you can't pursue. You could go into banking, you could go into financial management, insurance, you could open your own business because you have a lot of once you have knowledge about finances, opening a business is relatively easy. It's normally like one of the next steps. And there's specialized careers as well, like forensic accounting and environmental accounting and stuff like that. Creating accounting systems and software. And that is basically section one of your accounting syllabus. Believe it or not, it does get tested, so it's not something you should leave out. And let's take a look at some accounting concepts. You ever heard of accounting concepts before? The different rules and guidelines that govern how we do accounting? You heard about that before?
Yes, sir. Yes, sir.
Alright. These definitely, not only do they get tested, but they are connected greatly to a lot of the things that you do later on in the syllabus. So it's things that you need to know. A lot of people learn them early in Form 4 and then forget they exist and they don't see the connection later on, right? Hopefully, and within these next 3 days, you'll be able to see the connections. So the first one, the accruals concept, probably the most famous out of all of them because of how it comes up in the income statements and balance sheet later on. It says that expenses and revenue are recorded when they are earned or incurred, not necessarily when the cash is exchanged. That means if I have a sale in January, let's say I sell Giovanna something in January, but she pays me in February, which month would I record it for? Who could tell me? I sold her something in January, but she paid for it in February. Which month would I record it for? Based on your cross concept. Yes, Tisha.
February.
I see
So
Tisha. I
would it
see
be for
Tisha hand up.
February?
See that?
So
January.
would it be for February?
So it will be for February. Because
So
according to
January.
this, yep,
So January.
January. According to this, revenue expenses are recorded when earned or incurred, not when cash is exchanged. So if I sell it in January, I earned it in January. Even if they pay me in February, because I earned it in January, I will record it in January. If my rent in January is $5,000, but I could not afford to pay it in January, and I only paid it in February, how much would I record my rent as in January? Would I record it as zero? Or would I record it as $5,000? Who could tell me?
5,000.
$5,000.
$5,000, because that is when it was incurred. January's rent would be recorded in January, regardless of whether or not it was paid. That's what the accruals concept states. Right? So it doesn't matter when the money was paid. What matters is when it was for. Once it was for a particular year, you record it in that particular year's financial statements. Plain and simple. If my rent is $5,000 every month, and in January, I paid rent for January and February. I paid $10,000. How much rent would I record in January, and how much would I record in February? Who could tell me?
5,000 each.
5,000 each, correct. So you all understand the accruals concept, right? It's very important. It comes back when we do the income statements and balance sheets. For sole traders, partnerships, cooperatives, all of them, it comes back. This is the one that will be seen the most. The one that will be seen the second most is the prudence concept. A lot of people don't even know when they're seeing it. The prudence concept states that we record our assets and any income that we earn at the lowest possible value. And we record any liabilities or any costs at the highest possible value. We basically preparing for the worst case scenario. That way we could avoid overstating our profits. That's why we do stuff like provision for doubtful debts and why we have depreciation and things like that we will look at later on. Right? Because we don't want to overstate our assets and overstate our profits. So we record them at the lowest possible value. So if I have account receivable of $3,000, but we think 500 people might not, $500 I might not get back. My account receivable is 3,000, but I think I might not get back 500. How much would I record my account receivable as?
2,500.
2,500, correct. That is why when we look at provision for doubtful debts later on, you always minus your provision for doubtful debts from your receivables in the balance sheet because you're recording it at the lowest possible value. Right? You look at those things later on. And then we have the other ones, the consistency concept. If you use an accounting method, you have to use the same one over and over. You can't switch. So I cannot use the straight line method for depreciation 1 year and then switch to the reducing balance method the next year. You have to stay consistent. Separate entity concept. A business and its owner are treated as two separate entities. So you cannot put the owner's personal transactions into your financial statements. So I own Bally's Tutor Professionals. If I go and buy two doubles, I'm not going to record two doubles as an expense in Bally's Tutor Professionals. I teach at Corpus Christi College. I collect a salary at Corpus. I'm not going to record my salary as income in Bally's Tutor Professionals because my business and myself should be treated as two separate entities and the accounting should be kept separate. Everybody following so far? Yeah, no, maybe.
Yes, sir. Yes,
Mhm.
sir.
Just making sure. Right. So if you put personal transactions into it, it's gonna end up with misleading financial statements. So you just keep it separate. Mhm. And there are a few others like going concern. A business is considered a going concern if it's expected to operate in the foreseeable future. Um, a couple others, but those are some of the main ones. Now we have the accounting cycle. You're in Form 5, writing exam in a couple months, in a month, sorry, because next month is exam. You should know the accounting cycle by now. If not, please learn it. I'm gonna send another little video in on WhatsApp now. It's a little song that's help you remember the accounting cycle. I'm sending it now, 1 second. Alright, I just sent it. Alright, so you can check it out and see if it help you remember, right? But you collect your source documents, then you record them into your journals, then you post them to your ledgers, then you prepare your trial balance, then you prepare your financial statements, which are your income statement and balance sheet. You'll also need to know the different types of businesses. Luckily for y'all, just about everybody who does accounting does POB as well. Is there anybody here who's not doing POB? Raise your hand if you're not doing POB or never did it. Sha- um, so Shamal, you said you never did POB before? Shamal, you never did POB before? Principles of business?
No, son, about the POB.
Alright, no problem. I guess I just have one exception. But these are the different types of businesses that somebody could open, right? I was saying if you did POB before, then you would have seen these already. And they should have still seen it in POA though, if you wanted to do it in school. A sole trader is a business owned by one person. At the start of your accounting journey, most of your accounting, the first time you look at the income statement and a balance sheet, it would have been that of a sole trader. Then you would have done partnerships, which is a business owned, it says 2+ partners, but is owned by a minimum of two and a maximum of how much?
20.
Anybody?
20.
Right. 2 to 20 owners, right? Then we have limited liability companies. They are private limited liability companies and public limited liability companies. Private limited companies, they do not sell their shares on the stock exchange. They do not sell their shares publicly. They sell it privately, mostly to friends and family. And the maximum amount of owners they could have is 50. Public companies, they sell their shares publicly on the stock exchange, and there's no limit to how much owners they could have. You will have to do the accounting for limited liability companies as well. Cooperatives, they are businesses owned by their members. So to join a cooperative, you have to buy shares and become a part owner. Their purpose is to try to benefit the members of the cooperative, like credit unions. You'll have to do the accounting for cooperatives as well. And then we have non-profit organizations. Their purpose is not to make a profit, but to provide some sort of service. It could be a church, well, some churches, a charity, a club, and so forth, right? You'll have to learn some of the accounting for non-profit organizations. Right? There's an account called a receipts and payments account. You will have to learn how to do it, and you'll have to learn some of the key differences. Some of the financial statements you'll be doing. The first two are the ones you should be aware of the most. There's the first one is the income statement, also known as the trading and profit and loss. Its purpose is to calculate how much profit the company is making. It shows two types of profits, gross profit and net profit. To have anybody here that never saw an income statement before? Okay, great. Just making sure. And then your next friend is your balance sheet. Oh gosh, I don't have it in order. All right, that's okay. The income and expenditure account, you just need to know what it is. It's like the non-profit organization's version of the income statement. All right? Non-profit organizations, they don't use the words profit and loss because they're not trying to make a profit. Instead, they use the words surplus and deficit. Surplus, if you have a surplus, it means you have more money than you spent. If you have a deficit, it means you have less money than you spent. So instead of calling it an income statement, they call it an income and expenditure account, but it's practically the same thing. The next one you all should be very aware of is your balance sheet, also known as what? What is it?
Statement of financial position.
The statement of financial position. This is your next friend. You're gonna have to do this for sole traders. They may ask you to do it for partnerships. They may ask you to do it for corporations. In 2025, they brought a balance sheet for corporations. They may ask you to do it for cooperatives. They may ask, no, doubt they wouldn't really ask you to do it in a manufacturing account, but they might ask you to show part of it for manufacturing companies. The balance sheet needs to be a friend. You're gonna have to know the balance sheet inside and out. Right? It shows all of your company's assets, liabilities, and capital at that particular point. So it's show your assets, which is everything the company owns, OWNS. Liabilities, everything that the company owes, OWES. And it will show you capital. The capital is the amount of money or the amount of assets that the owner would have invested into the business. Right. Next one is your cash flow statement. Again, you just need to know what it is. They're not going to ask you to prepare a cash flow statement. It's just a statement that shows all the money coming into the business and going out of the business. It's separated based on three types of categories. Three types of inflows and outflows, sorry. Operating cash flows, investing cash flows, and financing cash flows. You just need to know what it is. You're not gonna ask it to prepare one, so don't worry. If you do it in Form 6, that'll be a different story. Next thing we're going to look at is the technology used in accounting. And I have seen this come in exam before, so it can come. Don't just ignore the small topics. We want all of our marks. We are greedy. It could be the difference between a 1 and a 2 or a 3 and a 4. Right? So, right now, especially in real life, technology in accounting is becoming a larger and larger factor. Right? Most companies no longer use physical books. They are all digital now. Right? Different examples of ways in which accounting process oh gosh, accounting software helps us. It helps with automation. It could calculate the salaries, for example, automatically, deduct the taxes automatically. It can help you keep track of your inventory. It can help you better manage the people that owing you money or the people you owing money to. These are some of the examples of accounting software. I need you to learn the names of at least 4, just to be safe. If you can know all, great. If you can't know all, know at least the names of 4. QuickBooks is probably um the most used one, followed by Sage Accounting. Used to be named the Peachtree Accounting, but it's now called Sage Accounting. Um, Oracle is a good one. I used Oracle before. The FreshBooks, Zoho Books, SAP, Zero, and there are other accounting software that's not even listed here. There's a huge amount of accounting software. I just gave you all some. See if you can learn at least 4, just in case. They ask you name 4 accounting software. Or then most likely they'll ask you to name 3. And if you know 4 and you forget 1, you still have your 3. So learn at least the names of 4, please. Right? Now everything has its advantages and its disadvantages, right? When you're using technology in accounting, it's going to be way faster than if you're writing with your pen and your pencil. It's going to be way faster. You're drawing up your lines and all them different stuff. When any accounting software, you just enter the information, they do up the statement for you automatically. It's reducing the chances of making human errors. I'm not saying that errors will not happen. It's still possible to have errors. It's just that you're gonna have less errors if you're using accounting software, or less opportunities to make errors. And you can get financial insight immediately. So I don't have to sit down and calculate different percentages and analysis and stuff like that. I could just click a button and get it done automatically or immediately. There are cons though. The cost initially will be high to purchase the software, and then some software require monthly fees or annual fees. They may also be required to be trained in the software, which could lead to a learning curve. Might take a while before you learn how to use it. And that might actually slow down productivity temporarily. And now that the information is digital, you're at a high risk of cyber threats. People could come and hack your information. As opposed to if you had it in a book, they can't get it so easily. Mhm. And let's take a look. Maybe look at the balance sheet. The balance sheet shows everything that the business owns and owes up to a particular period. Everything that the business owns is called assets. Everything that the business owes are called liabilities. Right? You all know this equation? You all ever saw this equation before? A equals L plus C or C plus L?
Yeah.
This is your accounting equation or your balance sheet equation. I need you all to know this by heart. What does C equal?
Capital.
No. If I had to put C equal what and what? If I had to
Asset
rearrange the equation.
liability.
C equals what and what?
Yeah, assets minus liability.
Assets minus liability. And L equals, what does L equal?
Yeah, assets plus capital
Not plus,
minus your capital.
minus capital. Assets is the only thing that you add to calculate. Assets equal liabilities plus capital. Everything else you have to subtract to calculate. Right? And it's always A minus something, not the other way around. So liabilities will be assets minus capital. Capital will be assets minus liabilities. Always assets first, right? Not the other way around. Right? Assets, everything the company owns. Liabilities, everything the company owes. Capital, the money used to invest into the business. Now, assets can be separated into two categories: current assets and non-current assets. Is there anybody that did not know that? There's things that you'll know. There's things you'll know, right? How long are non-current assets expected to last in a business?
More than a year.
More than a year. And how long are current assets expected to last in a business?
More than a year.
No. Non-current is more than a
Oh,
year.
less
Current
than a
would
year.
be less than a year. Correct. And you could give me two other examples of non-current assets besides building and machinery.
Motor vehicle.
Motor vehicle. One more.
Fixtures and fittings.
Fixtures and fittings, computer, furniture. And who will give me one more current asset?
Bank.
Cash at bank. Thank you. Somebody said land for non-current assets. That's a very good one. And you see those three: cash in hand, inventory, receivables, and bank, that fourth one you just mentioned. Try and remember those four current assets. Now, those are the four main ones. It's the first four that you look for: cash in hand, cash at bank, inventory, which is a closing inventory, and account receivable. Now, liabilities can also be separated into two categories: your current liabilities and your non-current liabilities. Your current liabilities, you expect to owe them, OWE, for less than a year, and your non-current liabilities, you expect to owe them for longer than a year. Anybody could give me one example of a current liability?
Overdraft.
Say that again.
Overdraft.
A bank overdraft, right? I could get one more.
Mortgages.
No, a mortgage would be a non-current liability,
Oh, so which
right?
one we own?
Current.
Oh, my bad.
That's all right. So a bank overdraft or your payables, because if you're owing people, you don't expect to owe them for longer than a year. Somebody say a 6-month loan, which is correct. Tisha, I seen your hand up. You want to give one?
Yeah, so for non-current, could a loan be one?
Yes, a loan could be one. So for non-current, you could have a regular loan once it's over a year, or a mortgage. All right? So far so good. All right. Now let's see if we could understand the books of original entry now. All right? Yes. How much books it have in all?
7.
All right. There are 7 books of original entry. Each book records something unique. All right? One of the things you have to be able to do when you're recording any books of original entry is distinguish between a cash and a credit transactions. A cash transactions occur when somebody pays cash. They actually pay money. And the credit transactions occur when the person doesn't pay you immediately. So they owe you money. So if I buy something from you and I say I'll pay you next week, that is a credit transfer, a credit transaction. If I buy something from you and I pay you immediately, that is a cash transaction. Everybody good with that, right?
Sure.
All right. Do you all know what source documents are?
Your receipts and stuff.
All right. If you had to define it, what you'll say? It's a document that proves a transaction took place. And you use different source documents for different transactions, right? Like your receipt, for example. So what happens? A transaction will take place. It will be noted on a source document. Then the source document will be used to record it in the relevant journal. And then from the journal, it would go towards the relevant ledger. So these are the 7 books of original entry. And each of them records something different. Who could tell me what the sales book records? Anybody? What does the sales journal or sales day book record? Yes, Alyssa.
So goods sold?
Close. Good soul how?
On credit.
On credit. So specifically good sold on credit. What about the purchases book?
Goods bought on credit.
Goods bought on credit. Correct. The cash book.
All cash transaction.
All cash and bank transactions. Petty cash book.
All small transactions.
Or petty cash transactions. Return inwards.
Goods returned to the business.
All right. Return outwards.
Goods returned to the suppliers.
Good. And the general journal.
All personal accounts.
Not all personal accounts. All other transactions not recorded in the first 6. Now, I want you to take note of something very important. For the sales book, we said goods sold on credit. For the purchases book, we said goods purchased on credit. Return and what book, we said goods returned by customers. Return outwards book, we said goods returned to suppliers. We only use those books for goods or inventory. Meaning, if I sell a non-current asset on credit, it does not go in the sales book. If I buy a non-current asset on credit, it does not go in the purchases book. If a non-current asset is returned to us, does not go in return outwards. If we return a non-current asset, it does not go in return outwards. On those transactions, or those books I should say, are only for goods. If those transactions occurred for non-current assets, we would record them in a general ledger, general journal instead. Purchases book or goods on credit, sales book. And you'll get the invoice for the purchases book and the sales book. You'll get the information, from an invoice. An invoice is a source document used when goods are bought or sold on credit. When goods are returned, the source document used is a credit note. When you pay for goods, the source document used is a receipt. For petty cash book, you'll use something called a petty cash voucher. And then for the general journal, it would vary. Because there are different transactions that could happen that could result in the item being recorded in the general journal. I think you all know the difference between cash transactions and credit transactions. Cash transactions to pay for it immediately. Credit transactions to pay for it later. Cash transactions would usually be in a cash book. Credit transactions, you'll probably look for it in the sales book or purchases book. Now, those source documents we were looking at before, the invoice and the receipt and the credit note and stuff like that, those are very important documents. They prove that transactions took place, which means they could prove the credibility of your accounting information. It is the very first record of a transaction. So when persons come to audit your firm to see if your accounting is true or not, they are coming to look at your source documents first. So it's very important when it comes to verifying the accuracy of your accounting. These are some of your source documents that you need to know. There's the invoice, which is used when goods are bought or sold on credit. If I sell something on credit, I will give an invoice, and that will be a sales invoice. If I purchase something on credit, I would receive an invoice, and that will be a purchaser's invoice. When goods are returned, we use credit notes. So if I return something, I would receive a credit note. If something is returned to me, I would give them a credit note. Debit notes are used to make adjustments. So let's say I sent an invoice for $900, but there was an error. It was supposed to say 1,000. I would send the debit note for 100, stating that the invoice was understated. Petty cash vouchers are used specifically for petty cash book, something we'll look at later on. And receipts are used whenever there's a cash payment. Once money pass, you have to use a receipt. So if somebody give me money, I would give them a receipt. If I give somebody money, they would give me a receipt. So, again, we prepare the source document. Then we match the source document with the correct journal. And then from the journal, it goes to the ledger. Now, when we have transactions that being recorded in the journal part, sometimes we might give or receive a discount. There are different types of discounts, and we need to know the differences. Specifically in accounting, it have two types of discounts that you need to know. A cash discount and a trade discount. The trade discount is given when you buy items in bulk. It is given immediately upon the purchase or the sale, and because it's given immediately, you don't have to make any additional record of it. So you come like the man say, hey, well, this is $10,000, but for you, it's $9,000. The discount was given immediately. I'm going to record the $9,000. I'm not going to record that it was $10,000 and I receive a $1,000 discount. I'm just recording $9,000. That's how trade discounts work. Cash discounts are different. Cash discounts have to be earned. Cash discounts are given to encourage prompt payment. So for example, Kyra owing me $500. I tell Kyra, hey, what, you owe me $500. If you pay me by the 10th of April, I will give you a 5% discount. She pays by the 10th of April, she earns the 5% discount. That is a cash discount. And cash discounts will be recorded. So trade discounts, no record is made, but there's a record for cash discounts. Right, so if it was a cash discount and it was 1,000 and I give $100 off, I will record that it was 1,000, but I gave 100 off. If it was a trade discount and it was 1,000 and I was given 100 off, I am just going to record it as 900. You'll understand what I mean when I say it's not recorded, right? Yeah, no, maybe.
Yes, sir.
Just making sure. So when you're doing a cash book now, and we'll take a look at one today. We'll take a look at a cash book and a petty cash book today, right? We'll take a look at all the journals actually. A quick look at all of them today. When you're balancing a cash book, the debit side records all the money you're getting, which is the side on the left, and the credit side records all the money you're spending. To calculate your balance carry down, you add up the larger side and minus the smaller side. You all know how to do that? You would have done that before in all your cash book. We'll be looking at one today either way, so we'll find out. Same thing with the petty cash book. We'll be looking at one today as well, right? So for petty cash, in businesses, to avoid using the main business account for small transactions, they might create a petty cash system where they put a small amount of money in the office called a float that they use from every month to pay for your small cash transactions. So for example, let's say it's $500. Somebody will be given the $500 to hold, most likely the petty cash officer. And every time a small transaction is needed, you'll use money from that $500. At the start of the following month, that 500 will be replenished. So if you had spent 400 in the previous month, at the start of the next month, you'll get back that 400 to bring it back to your original amount. And then they use from the money again. And every time you take money from the petty cash, something called a petty cash voucher will be created as the source document to record it. We will be looking at one, so you'll see what it looks like, right? So this question is from January 2025, right? So it's fairly recent. And he gave a list of transactions and they wanted you to record it in the relevant journals. And the journals that they asked for in this one is your sales journal, purchases journal, cash book, return inwards, return outwards, and general. So it was 6 out of the 7. Here's what we're going to do. With our knowledge of our different books of original entry and what transactions goes into which, we're going to go through each of these transactions one by one and see if we could figure out which journal they're supposed to go into. You think we could do that? Take the silence as yes.
Yes, sir.
So let's start with the first one. Received an invoice for goods for resale from Z Fashion House 6,000. Less a 25% trade discount. If we receive the invoice, who is selling the good? Us or them?
Them.
Them. So if they selling the good, that means we are doing what?
Receiving the goods.
Alright, so we'll be buying the goods, right?
Yes, sir.
Alright, and if it's an invoice, did we pay money for it?
No, sir.
No. Alright. So what journal would that go into?
Purchases journal.
Correct. And how much money would we record in the purchases journal? Anybody knows?
4,500.
4,500. He would take no record of the 25% trade discount. He's just going to subtract it. Right? So this would go in the purchases journal. Next one. Cash register tape showed cash sales totaling 13,954. Which journal would that go into?
Cash book.
The cash book. Once it's a cash or bank transaction, doesn't matter what it's for, goes into the cash book. So if you paid advertising expense in cash, that goes where?
Cash book.
Cash book. If you banked $10,000 cash, that goes where?
Cash book.
Cash book. Now this one, we received a credit note from Z Fashion House. Credit notes are used when what happens again?
Purchase goods on credit.
Invoices are used when goods are bought and sold on credit. What do we use
Goods
the credit note for?
When goods are
when we
returned.
are send,
When,
receive, return inwards or return outwards.
right, when goods are returned. So let's see if we could figure out what this is. Received a credit note from Z Fashion House for goods returned as damaged. If we are receiving the credit note, who returned the goods?
To us,
Correct. So if we are returning the goods, would that be return inwards or return outwards?
return
Return
outwards.
outwards.
Correct. So it goes in return outwards journal. Mhm. Received an invoice totaling 4,790 for additional shelves and mannequins for the business. Which journal would that go into?
Purchases.
So
Somebody said it. The
general
general
journal.
journal. Correct. Why?
Because it's not goods we bought.
Correct. It's not goods. Additional shelves and mannequins would not be sold in a clothing and accessory store. Those will be used as non-current assets. When you buy and sell or return non-current assets, they go in the general journal. Next one, we issued an invoice for goods. If we are given the invoice, did we buy the goods or sell the goods?
Sell them.
Sell them, correct. And if we're given an invoice, is it cash or credit?
Credit.
So which
Credit.
journal would it go into?
Return.
No, we selling on
Oh,
credit. If
So
we
what did
selling
we
on
Sales
say?
credit,
journal.
sales.
What did we say was journal?
sales journal or the sales book. Returned 1,200 worth of additional shelves. Which journal would that go into?
Return outwards.
Return out. No, not return outwards. Why not return outwards? Because what are they returning? Are these goods or are they a
No,
non-current asset?
non-current.
Non-current asset.
So which means to go where? Which journal then?
In the
General.
general journal.
General journal. Next one is issued a credit note. Credit notes are used when we do what again?
When we return goods.
Right. So if we are issuing the credit note, did we return the goods or were the goods returned to us?
Goods
Return
returned
to
to us.
us.
Right. So if the goods are being returned to us, is that return inwards or return outwards?
Return
Return.
Return
inwards.
inwards.
Right. So that'll be return inwards journal. And then we paid Z Fashion House by check. What journal is that?
Cash book.
So what did we
Cash book.
Book.
Correct. And then we received a check from Queen B. Which journal would that go into?
Cash book.
Cash book.
Correct. Right. Now, because of the nature of the crash course and the size of the syllabus, I can't go through in full detail the different journals and the cash book and all those stuff, right? Because it'll take a while. Well, what I will do is I will send this answer to you all so you all could go through it on your own. All right, so I'm actually going to send it to you right now. So you will have it. And then we're going to take a look at a petty cash book and then we're going to move on. We're going to take a look at this petty cash book now. They said a petty cash for TD Salon was given $1,500 on the 1st of April 2022 to start a petty cash book, which will be maintained on the Impress system. Analysis columns are provided in the petty cash book for stationery, cleaning supplies, and wages. So let me show you what the petty cash book would look like. This is it here, right? You have receipts on the debit side, and then total and different analysis columns on the credit side. These are payments. I start to the month. You will be given a certain amount of money to use for petty cash. So they said they were given $1,500. It would normally come from your cash book. So for the first of April, the first of the month, you put cash book and you put the amount of money. Right. Now, each of these transactions here will be recorded in a relevant payments column, right? If it's for stationery, you'll record it under stationery. If it's anything to do with cleaning supplies, it goes under cleaning supplies. If it has anything to do with wages, you record it under wages. And then you'll record the amount under total as well. It's that easy. Say purchase mop buckets, brushes, and dusting cloths. Will that be cleaning supplies, cleaners' wages, or stationery?
Cleaning supplies.
Copy paper and pens. What would that be?
Stationery.
Stationery.
Cleaner was paid wages. What would that be?
Cleaners
Cleaner
wages.
wages.
Board envelopes, computer ink and staples.
Stationery.
Stationery.
Board cleaning supplies.
Cleaning supplies.
Cleaners' wages were paid.
Cleaners
Cleaner
wages.
wages.
That simple. Right? So you record cleaning supplies, you record it under cleaning supplies, then under total. Paper and pens under stationery, then under total. Paper and pens. Sorry, cleaning supplies under cleaning supplies and total. Paper pens under stationery and total. Cleaning wages under cleaners' wages and total. Stationery under stationery and total. Cleaning supplies, you record it under cleaning supplies and total. Cleaners' wages, you record it under cleaners' wages and total. After that now, you're going to record the total of all of those columns. The different analysis columns and the total column. But you're not going to you're not going to underline the total column. So you notice I have a line above and below the analysis columns, but only have one line for the total column, right? Because only put in one line because you're not finished with it yet. I have to record all my totals. I have to record how much money I have remaining. And that will be my balance carried down. So I'll look at the amount that was given with it to start, which is the 1,500, and then I'll minus the total I spent, which is 1,484. And that will give me my balance carried down. After I get my balance carried down, then I'll do the totals for both sides. The receipts and the total column. I'll put the totals and it's supposed to be the same. And then the first of the following month, my balance brought down will be that same 16, but on the debit side. After I put my balance brought down, so just to repeat, I will calculate my balance carried on by taking the 1500 from the receipts and minusing my total in the total column, which is 1484. That's how I got the 16. Then I would put my totals on both sides, which is how I got the 1500 on the receipts and the 1500 on the total. And then the first of the following month, I'll put my balance brought down as 16 on the receipts. So that is the amount of money I still have at the start of the next month. And then I will put back the money that I spent last month to bring the float back up to date. So I'll take 1484 from the cash book. It is basically a petty cash book. Alright. I shall also send you all this, as well as the other parts of the question. And you can go through it on your own as well. And here, we shall take our first small break. These are some of the things we're going to look at now. Different ledgers that we use, how we classify accounts, when to debit and when to credit, which ledgers to use and so forth, right? So when it comes to the classification of accounts, there are three types of accounts. The first one is nominal accounts. Nominal accounts are intangible. These are the accounts for things that you cannot touch. Right? These accounts normally last until the end of the financial year and then they're transferred to the income statement and you open the next one in the next year. So these will be things like your sales, your purchases, your rent, advertising, insurance, telephone bill, light bill, and so forth, right? Intangible accounts. Your real accounts are the tangible accounts. These last much longer. These would be mostly found in your balance sheet. These will be things like your plant and machinery, building, motor vehicle, computer, your cash, money in your bank account. These are things that you could actually touch, right? The account for things that you could touch. And finally, you have your personal accounts. These are the accounts for people and businesses. It will mostly be your account receivable, that is the people that owe you money, and your trade payables, the people that you owe money to. Those are your personal accounts. You'll have individual accounts for each of them. So again, you have nominal accounts, the intangible ones. Then you have real accounts, accounts the tangible ones. And then your personal accounts, your accounts for people and businesses. Right. Now you have three types of ledgers. You have your general ledger, your sales ledger, and your purchases ledger. All of your real and your nominal accounts will be recorded in the general ledger. Now, your personal accounts, specifically account receivable, people that owe you money, their accounts will be located in the sales ledger, and the
Sir, I have
people
a-
you, sorry?
is the general ledger like similar or another name for general journal?
No, the general journal is your book of original entry. Your general ledger is where your T accounts are located. So your ledgers is where different T accounts are located. So you all know what a T account looks like? And it's shaped like a
Yes, sir.
T. You'll have the name of the account on top, and you'll have the details, amount, and so forth. The ledgers are where T accounts are located. So all of the T accounts for your real and nominal accounts will be located in the general ledger. So it'll just have like the name general ledger, and then all of the T accounts will be underneath it for your real and nominal accounts. In the sales ledger, all of the T accounts for your different account receivable, the different people that owe in your money, all of their T accounts will be in the sales ledger. And then the purchases ledger, all of the T accounts for your trade payables, the people that you owe money to, will be located there. You following? Yeah, no, maybe?
Yes, sir.
Yes, sir.
Yes, sir.
Alright, just making sure. Alright, so some people, small businesses, they wouldn't have multiple ledgers. You just have all their T accounts recorded in one place. Right? It makes it less complicated for them, and it's not like they have much accounts in the first place. But larger companies are normally separated to reduce the clutter, make it easier to track the different accounts and so forth. Now, we're gonna look at the double entry rule. You ever heard of the double entry rule before?
Yes, sir.
Yes, sir.
The double entry rule, every transaction has a debit and an equal credit. Every transaction has a debit and an equal credit. So I'm gonna try and make this information here about which accounts to debit and which accounts to credit a little simpler. Mhm. So you have a couple options, right? You have this one, dead click. On the debit side, you have your expenses, assets when they increase, and your drawings, DEAD. And click on the credit side, you have liabilities when they increase, your income, and capital. That's one way to remember when to debit or when to credit, right? A more detailed and accurate version is this, but I'm sending you both, so you could choose whichever one, right? For assets, liabilities, and capital, you have to remember this. When assets increase, we debit. When assets decrease, we credit. Liabilities and capital are the opposite. When liabilities decrease, we debit. Same thing with capital. And when liabilities and capital increase, we credit. So for example, if I took a loan for $10,000 cash, is my cash increasing or decreasing?
Increasing.
Increasing. And since as cash is an asset, what would I do, debit or credit?
Debit.
Right. I just took a loan. So does the amount I owe increase or decrease?
Increase.
And when liabilities increase you, what is it? When liabilities increase, you credit. So every transaction will have a debit and a credit. So for assets, liabilities, and capital, that's what you do. When assets increase, you put it on the debit side. When assets decrease, you put it on the credit side. Liabilities and capital, when they decrease, it goes on the debit side. And when it increases, it goes on the credit side. That is the rules for assets, liabilities, and capital. Now for the other accounts, I use an acronym called PRIDE. PRIDE. PRIDE stands for purchases, return inwards, drawings, and expenses. And these accounts are always debited. So once you record in any purchases account, to your account, you're going to debit. You're recording a transaction in a return inwards to your account, you're going to debit. You're recording a transaction in a drawings account, you're going to debit. You're recording a transaction in any one of your expenses accounts, you're going to debit. The return, all the other accounts now, which will be sales, return outwards, and your revenue accounts, are always credited. So once you're recording a transaction in your sales to your account, you're going to credit. You're recording a transaction in your return outwards to your account, you're going to credit. You're recording a transaction in any of your revenue accounts, you're going to credit. This is what a T account looks like.
Sir,
Yes?
you could go back to Pride, please.
Sure. Purchases, return inwards, drawings, expenses. PRIDE. These accounts always debited. And then sales, return outwards,
Thank you.
and revenue, always credited. This is what a T account will look like. For those who may not know. You'll have the name of the account. The left side of the account is the debit side, and the right side of the account is the credit side. Everybody would have seen a T account before, right?
Yes, sir.
Alright. Just making sure. Alright, so we have to, when you have a transaction, you'll have to identify the accounts that have been affected. We'd have to determine if it's being debited or credited, and then we'll have to record it in the relevant accounts. Remember, every transaction will have a debit and an equal credit. Right. So before we move on to this part, let's just take a look at a past paper question. Right, so this was number 5 in 2024. And you see how much transactions they give for you. They give you 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and 12, 13, 14, 15 different transactions And you had to record all of these transactions into the relevant T accounts.
Which number question is this again, sir?
2024 number 5. Alright, so they would have, well, I filled it in already, but they would have left a whole bunch of blank T accounts. And you had to go through each transaction and record them in the relevant T account, right? Now I put this information here in case we forgot the double entry rules. For assets, when they increase your debit, when they decrease your credit. Liabilities and capital are the opposite. When they increase your credit, when they decrease your debit. For the other accounts, we use the acronym PRIDE. PRIDE stands for purchases, return inwards, drawings, and expenses. PRIDE is always debited. Or the remainder of accounts, sales, return outwards, and revenue, always credited. Using this information, we're going to go through each of these transactions, see what accounts would be affected, and if we're going to debit or if we're going to credit. Sound like a plan?
Yes, sir.
So let's look at the first transaction. The owner made a bank deposit from his personal resources, 75,000. What two accounts would be affected there?
Bank and
Bank and capital.
And capital. When you invest money into your own business, it's capital. Right. Now, do we have more money in our bank account or less money in our bank account?
more
We have more.
And when assets increase, you
debit.
debit. Automatically, if we debit in our bank account, what are we going to do to cash?
Credit.
Credit, right? Correct. But let's look at the rule. Did we invest more capital or less capital?
We would have invested more capital.
More. And when capital increase, what do we
We
do?
will
Credit.
Credit. So you see it fits. Let's look at the next transaction. Withdrew cash from the bank for business use. So we taking money from the bank account and putting it into the cash account. What's happening to our bank account? Is it increasing or decreasing?
It would increase.
If we taking money from the bank account,
It'll decrease.
Decrease.
right? And what will we do to our bank then? Debit or credit?
Credit.
Credit.
Right. And when we put the money in our cash account, would cash increase or decrease?
Increase.
And what will we do?
Debit.
Right. Next transaction. Proceeds from sales were banked. Sales is always what?
Credit.
Right. So we'll credit sales, which means automatically what we doing to the next account?
Yeah, debit.
Debit.
Now
Bank.
what's the next account? Bank, right? Well, let's look at the rule. If we sell something, that means we get money, right? Which means our bank increase.
Yes, sir.
And when assets increase, we
Debit.
right. Use the check to purchase a used delivery van with extra parts. Check means what account?
Bank.
Right. If we pay in a bank money with our bank account, is it increasing or decreasing?
Decreasing.
Decreasing.
What will we do?
Credit.
Credit. And what account will we debit?
Motor. Van.
So the delivery van and spare parts account, right?
Yes, sir.
Because it's an asset, and when assets increase, we debit. Bought inventory on credit from Rob Smith. The terms were 5/10, net 30. Does anybody have any idea what that means?
No, sir.
All right,
Is
so
it?
what those terms
Yes,
mean?
sir.
All right, explain it.
So what they're trying to say is the inventory was sold on credit 2 out of 10 times of the 30.
Mm-hmm.
Uh,
It
is
means, yes. Yeah.
is it you'll get a 2% discount if you pay within the 10 days, and that you'll get 30% discount.
Well, 5% discount, but yes. So they say the terms are 5/10 net 30. It means if you pay within 10 days, you get a 5% discount, but you must pay within 30 days. All right, so the payment is due within 30 days. That's what net 30 means. But if you pay within 10 days, you're getting a 5% discount. So 5/10 net 30 means 5% discount if you pay within 10 days, but full payment is due in 30 days. You'll understand?
Yes, sir.
All right. So when we buy inventory, when you buy goods, what account do you use?
Purchases
Right, and purchases is always,
debited.
so you debit purchases, and then what account you credit? Who did we buy
Um,
it from?
Rob Smith.
Rob Smith. Because we bought it on credit from Rob Smith, so we will credit Rob Smith's account. So since we owe Rob Smith money, right? Which ledger would you find Rob Smith in? Would he be in his sales ledger, purchases ledger, or general ledger?
general ledger.
Mm-mm. We owing him money, so he would be in the purchases ledger. Remember, the purchases ledger has the T accounts for all of your trade payables, so everybody that we owe money for. And we owe money to him, so he would be in our purchases ledger. Alright. What does 2/10 net 30 means? Who
So
thinks you
guys,
know?
you wanted a mistake on phone and explain it to you instead of the
Oh,
5.
explain it to me again.
I say that um the inventory which I don't know what I said exactly, but I did say something along the lines where I did say out of the 2 to 10 days, they had to pay within, but I had to pay within the 30 days.
Something like that, right? So the
Mm.
first number is the percentage discount you're getting. The second number is the amount of days you have to pay to earn the discount. And the third number, the net number, is the latest you could pay it. So if you pay within 10 days, you're getting a 2% discount, but you must pay within 30 days. That is what that means. So the first number is the discount, the second number is the days required to earn the discount, and the third number is the most amount of days you can wait before paying. So we sold inventory on credit to S. Peters, right? Sales is always,
Credited.
Credited.
so we will credit
Credited.
sales. And what you do to S. Peters?
Debit.
Debit.
Debit. Good. Cash sales. What two accounts? Well, there's only two words there, cash and sales. So that's the two accounts, right? Sales would be
Credit.
credited, and if you credit in sales, automatically what we doing to cash?
Debit.
Debit. So you all have the idea, right?
Yes, sir.
Right. So
Yes.
I'm going to send this answer to you all as well. So you all could go through and see when we debit and when we credit in the various accounts, right? Right. So now to balance a T account. To balance a T account, you compare the debit side and the credit side. Let's see which side is bigger, which side is smaller. So let me show you all. We're gonna do one right here on the board, or right here on the PowerPoint. I have here date, details, amount, date, details, amount. Let's say it's a cash account. Let's say on the 8th April, you had sales 9,000. 10th April, transferred money from the bank account, 14,000, and 18th of April, you had purchases of 12,000. So these are the transactions. Now it's time to balance the account. The first thing I do, I compare both sides, the debit and the credit side. I'm looking specifically for the side that's smaller. Which side is smaller? Debit side or credit side?
The credit side is
Credit.
smaller.
The credit side
Credit
is
side.
smaller. Alright. I go to the smaller side. I put the date as the last day of the period. So in this case, we're looking at April. The last day in April is the 30th of April. The details now, I'm going to put the details as balance carried down or balance carried forward. Or for short, I'm going to write BALC/D. BAL is short for balance, C/D is carried down. And then the amount I'm going to put is the amount of cash I have remaining. Or in other words, the difference between both sides. So I'm going to add up the larger side, and I'm going to minus the smaller side from it. 9,000 plus 14,000 is how much?
22,000.
23,000. 23,000 take away 12,000 is how much?
11,000.
11,000. So that's what I'm recording here. Right? This figure is supposed to make both sides equal. That's what they call it balancing. Both sides supposed to balance off. So after I put that, my balance carry down, to show that both sides are equal, I put my totals on both sides. So I'll put my two lines to signify that is the totals. And my total on both sides should be equal because I just balanced it. 9,000 plus 14,000 is 23,000. 12,000 plus 11,000 is 23,000. We're not finished. We have one more step. On the first of the following month, so that was the end of April, the next month is May. On the opposite side of the balance carry down, so on this side, after my totals, I'm going to put the 1st of May. The details will be balance brought down or balance brought forward. I'm going to write BAL, B/D for short, and the amount will be the same as the balance carry down, 11,000. This means, so the 30th of April, the balance carried on means that's the amount of cash I had at the end of April, and the balance brought down on the 1st of May means that's the amount of cash I'm starting off May with, 11,000. That is how you balance a T account. So once your debit side is bigger than your credit side, you would have what we call a debit balance. Assets will always have debit balances. Once your liabilities, sorry. Sorry, once your credit side is bigger than your debit side, then you have a credit balance. Liabilities would have credit balances. Hmm. Everybody good there, right? That's how to balance it to your
Yes,
account.
sir.
Yes, sir.
Now those balance brought downs, whether on the debit side or the credit side, would be used to create your trial balance. So once you finish recording all of it to your accounts and you balance all of them, you'll take all your balance brought downs and create the trial balance. Trial balance will look like this. You'll have the name of the company, trial balance for the period ending, and you'll put the date. And then you'll have three headings: details, debit, credit. Under details, you'll put the name of the account, cash for example, and then under debit or credit, you'll put the balance brought down. And you'll keep doing that, listing out all of the accounts. And when you finish, the debit side should be equal to the credit side. Now remember, assets have debit balances. All assets, their balances will be on the debit side of the trial balance. Liabilities and capital have credit balances. They would be on the credit side of the trial balance. If you can remember, just remember what side they increase on. When assets increase the debit, they would be on the debit side of the trial balance. Liabilities and capital, when they increase your credit, you'll find them on the credit side of the trial balance. And then we have pride, purchases, return inwards, drawings, and expenses, all on the debit side. And sales, return outwards, and revenue will all be on the credit side. So they could give you a trial balance, but put items on the wrong side and tell you to fix it. And you have to know those things. You have to know, all right, all assets, they should be on the debit side. The liabilities and capital, they should be on the credit side. Hey, there's an expense. This expense is supposed to be on the debit side. There's a revenue. This revenue should be on the credit side. And so forth. You should be able to do that. Right? Now, trial balance is used to create the income statement and balance sheet. So it's a basis for preparing the financial statement, right? The income statement and the statement of financial position or the balance sheet. It can also be used to detect some errors. Notice I said some errors. The thing is, the trial balance cannot detect all errors all the time. So just because your debit side and your credit side are equal, it does not mean that there are no errors. A trial balance never guarantees accuracy. A question like that could come. When does the trial balance prove that there are no errors? And the answer is never. Keep that in mind. If your trial balance balanced, there's less likely to be errors. But that doesn't mean there isn't any errors. Always remember that, please. And now we go to another past paper. So control systems are systems put in place to reduce and detect errors. When it comes to control systems, there's three things you have to look at: errors and a suspense account, control accounts, and bank reconciliation. We're going to look at bank reconciliation first. So as you all know, our cash book records all of our cash and all of our bank transactions. Right now, we're focusing on the bank transactions. Once we have a transaction that involves our business bank account, it goes in our cash book. Where else records all of our bank account transactions?
In general,
I'll give you a hint. It's not us, somebody else. Who would have all record of all of our banking transactions?
the
The bank.
actual bank.
The bank, correct. So the cash book would have all of our banking transactions, and the bank would have all of our banking transactions. So supposedly, they're supposed to be the same, since they're recording the same thing. But in most cases, that's not the case. So when they are different, we have to check to make sure that no errors are made, no fraud taking place. Unless it's benefiting us, then we could leave it. As a joke, huh? Don't leave any fraud. You could actually get in trouble if you detected the fraud and it didn't report it. You could actually get in trouble for that. So the process in comparing the cash book and the bank statement to see what the differences are and why, is called bank reconciliation. That is why we do it. Now, besides errors and frauds, there are a lot of legitimate reasons why the cash book and the bank statement could be different, right?
Yes, sir.
Let's take a look at some. For one, we have something called unpresented checks. You all ever heard of unpresented checks before?
Yes, sir.
All right. That's when you pay someone with a check, but that person did not present the check to the bank as yet. So I pay Chelsea a $10,000 check. And when I pay Chelsea my $10,000 check, what would I have done to my cash book? Would I have debited or credited?
Credit.
Right, I credit my cash book because I paid Chelsea a $10,000 check. But Chelsea rich, and 10,000 is pocket change for her. So she just put it in her drawer and say she'll cash it whenever she get a chance. Would the bank know that I gave her a $10,000 check?
No.
No.
No. So because they wouldn't know, I would have a record of it in my cash book, but she would not have a record of it in her bank statement. So that could cause a difference. You understand?
Yes, sir.
All right. Next one, late lodgements. That's when I deposit money too late for it to appear on the bank statement. So let's say it's the last day of the month, I go and deposit $20,000 in my bank account. What would I do to my cash book? Debit or credit?
Debit.
Debit. I would debit my cash book. But if I record it on if I transferred it on the last day of the month, let's say I transferred it from my FCB, my First Citizens account to my Republic Bank account, from one bank to the other, and it takes a day to process it. Would it be in my bank statement for that month?
No.
No. So it would be in my cash book, but it would not be in the bank statement. And that could cause a difference. Right? Those are the two differences that would cause something to be in the cash book, but not in the bank statement. Now we're going to look at things that would be in the bank statement, but not in the cash book. So the opposite. So a standing order. You all know what a standing order is?
Yes, sir.
Alright, it's an order to the bank to pay money from your account to our next account periodically. So I have a phone bill. Instead of going to the phone company every month to pay it, I could say, hey, what, bank, every month I wanted to transfer $300 to this phone company and say it's for my phone bill. That's a standing order. And the bank will do it automatically every month. So let's say 1 month comes and I forget. If I forget, would I record it in my cash book?
No, sir.
No, sir.
Would the bank forget?
No, sir.
No, sir.
So it will be in the bank statement, but not in the cash book. Direct deposits. This is when you give a creditor or a trade payables, somebody that you owe money to, permission to withdraw payments directly from your account. So you owe them money and you give them permission to draw the payment directly from your account. If they do so, sorry, if they do it without informing you, and you don't have any notifications on to be notified when there's a banking transaction on your phone or something, if they do it without notifying you, will you have a record of it?
No, sir.
No, sir.
Will the bank have a record of it?
Yes.
Yes, sir.
All right. That could cause a difference. Bank charges. So every month, the bank would charge you for using all of their facilities. Every time you withdraw money, or you swipe your card, or you check your balance, you'll add up all of these small charges and put it together at the end of the month. You will have no idea what your bank charges are until you get your bank statement. So this will always be one of the differences between your cash book and your bank statement. You'll never have it recorded in your cash book, and it would be in the bank statement. Then you have dishonored checks. So a dishonored check occurs when somebody pays you a check, but they do not have enough money to honor it. So how a check works, if I give, let's say I give Tanisha a check for $3,000 and she carries it to the bank, that check is basically me giving an order to the bank to take $3,000 from my bank account and give it to Tanisha. So let's say I give Tanisha a check for $3,000 and she mails it to the bank. When she mails it to the bank, what is she going to do to her cash book? Debit it or credit it?
Debit.
Debit, because she just got money. The bank receives it, puts the money in the statement. But then when they go to take the cash from my account, they realize I only have $7 in my bank account. So I cannot honor the check. So they mail the check back to Tanisha, writing refer to drawer on the check, telling her she has to talk to me about it. Until she gets that mail, would she know that the check is dishonored?
No, she wouldn't.
Would the bank know?
Yeah.
Yes, sir.
Right, and that could cause a difference as well. Right, so all of those are examples of legitimate reasons why the cash book and the bank statements could be different, and it does not have to include fraud or errors. However, it is also possible for there to be fraud and for there to be errors that cause the difference as well. The error could happen on the business owner's side in their cash book, and the error could happen in the bank side, in the bank statement. It is possible, Whenever it happens, you just have to deal with it accordingly. Right? So this is how we do bank reconciliation. The first thing we do is look at the cash book and the bank statement and look for differences. One thing you have to know, the bank statement is done from the perspective of the bank, and the cash book is done from our perspective. So for us, when we put money in our bank account, we are getting money, right? So we would debit. And when we take money from our bank account, we are losing money, so we would credit. And that is true?
Yes, sir.
Right. Banks look at us as a liability. So when we put money in our bank account, for the bank now owes us that money. So the amount that they owe us just increased, so they would credit. So whenever we put money in our bank account, the bank would credit it because the bank know they now owe us that money. Whenever we take money from our bank account, the bank now owes us less money, so their liability decreased, so they would debit. So the bank basically records it to the opposite way we record it. When we get money, we debit. When we spend money, we credit. But for us, when we put money in our bank account, that's us getting money, so we debiting, but the bank is going to credit because that's them owing us more money. When we spend money from our bank account, we are going to credit our cash book, but for the bank and the bank statement, they are going to debit their bank statement because they now owe us less money. So what will be on the debit side in our cash book will be on the credit side of the bank statement. What's on the credit side of the cash book will be on the debit side of the bank statement. So keep that in mind when you're comparing the cash book and the bank statement, right? So you're going to compare them and you're going to try and look for the differences. You're looking to see what's in the cash book, but not in the bank statement. And you're looking to see what's in the bank statement, but not in the cash book. I say first step. Your second step now is that you're going to do over your cash book. So you're going to take the cash book that you had before and everything that you found out that was in the bank statement, but it was not in the cash book, you're now going to include it into your cash book. And then calculate a new cash book balance. But remember, you're only looking at the bank column only, yeah? We're ignoring the cash column for now. Alright, so you're going to do over your cash book, but the bank column only. And everything that you found that was in the bank statement, but not in the cash book, you're going to put it into the cash book. And then get a new cash book balance. And then the third step is to do something called a bank reconciliation statement. You start off with your revised cash book balance, and then you add any unpresented checks. Remember we said that would be in the cash book, but not in the bank statement. That's checks we paid to people, but they didn't cash it yet. And if you're paying it to them, it will be on the credit side of the cash book. You're going to add those, and then we're going to minus any late deposits. And when we do that, the answer we're supposed to get is the same balance as the bank statement. If we don't get that same balance, that means there was an error somewhere or there was fraud somewhere. Let's see if we could take a look to see what you mean, right? Let's compare these two. The bank column for the cash book for May 2011 and the bank statement for the same amount for C White as shown below. And we have to prepare the revised cash book. So the first thing we're going to do is compare the cash book with the bank statement. Right now, the cash book has a balance carried down of 500 at the end, But the bank statement latest balance is 400. So they are different. So we need to do bank reconciliation. So the first thing, we observe both of them and we look for the differences. I want you all to take a moment, look for the items that are in the bank statement, but not in the cash book. And I want you all to send it to me directly. Send it in a chat on Zoom to me directly, the ones that you find. I'll give you 2 minutes. All right, so most people got it. It would have been the bank charges, the direct debit, the credit transfer, and the dishonored check. So we identify the differences. The next step now, going back up for a second. The next step, we are going to start off with either re-entering all of the items in the previous cash book, or we're going to start off with the latest balance carried down as our new balance brought down, which is a lot faster. So this balance carried down as 500. We're going to start off with that as a balance brought down in a new cash book or revised cash book. And then we're going to record all of those items. Now, how to know where to record it? Two things we could look at. First one, if we get in money or spending money. If we get in money, we know it goes on the debit side. If it costing us money, it goes on the credit side. Or we could look at where it is in the bank statement. If it's on the debit side in the bank statement, where would it go in the cash book?
Credit.
Credit side.
Credit side. And if it's on the credit side of the bank statement, where would it go in the cash book?
The debit side.
Debit side.
Correct. So bank charges, debit or credit?
Debit.
Credit side.
Credit side. So the debit side in the bank statement. So credit side of the cash book. Direct debit.
Credit side.
Credit side. Credit transfer.
Debit side.
Debit side. Dishonored check.
Credit side.
Start off with our new latest balance carried on. So our balance brought down. Bank charges. Direct debit, dishonored check. All on the credit side, just like you said. Credit transfer on the debit side. Then we calculate our new balance carried on and brought down. So our revised cash book balance is now 350. So that's 2 steps now. We identify the differences and we updated our cash book. The third step now is the bank reconciliation statement. We're going to start off with this revised cash book balance and then any unpresented checks. We're going to add it. Any late deposits, we're going to subtract it. And the answer we get after doing that is supposed to be the bank statement balance of 400. Let's see if we could identify the unpresented checks and the late lodgements. Unpresented checks are checks that we paid to persons, but they didn't carry it to the bank as yet. So if we paid it to them, would it be on the debit side or credit side of our cash book?
Credit.
Would it be in the bank statement? If they didn't present it to the bank? No. So to get our unpresented checks, we're looking for something that's on the credit side of the cash book, but not in the bank statement. Anybody can find it?
Campbell.
C. Campbell.
C. Campbell. Correct. So C. Campbell would be our unpresented check. Now, a late lodgement is when you deposit money too late for it to pay on the bank statement. If we deposited money, it will be on the debit side or credit side of our cash book.
Debit.
But will it be in the bank statement?
Not for this year
Right.
or term.
All right. So you have to look for something that's on the debit side of the cash book, but not in the bank statement, and that would be what?
All right.
All right. So we're gonna start off with our cash book, new cash book balance. Add our unpresented check of C. Campbell and minus any late lodgements, which would have been all right. So we start with the 350. We add the unpresented check. We minus the late lodgement. That gave us our bank statement balance. The same 400. Now a question could come where they give you the bank statement balance and tell you do the bank reconciliation statement to find the cash book balance. If they tell you that, you have to do the opposite. So you'll start off with your bank statement balance. Instead of minusing your lodgements, you'll add it. And instead of adding unpresented checks, you'll minus it. Just something to note, right?
Yes, sir.
Gosh. So they had this question here. May you notice in this question, they didn't give you a cash book or a bank statement. What they did was they tell you the cash book balance, and then they tell you the differences. So you have to prepare your updated cash book by reading each difference and figuring out what to do, and then do your bank reconciliation statement. So let's try it. The cash book for C. Tracy at the 30th of February showed a debit balance of 10,030. On comparing the cash book and the bank statement, the following differences were discovered. So they highlight the differences first. A check paid to a creditor for 1894 was entered in the cash book as 1984. So you have an error error on our side. Direct credits received by the bank, so that's money we get because they say received, but not yet entered into the cash book, 500. Bank charges not entered in the cash book, standing order, etc., etc. Let us first go through each of these, and we're going to say one, whether it would go in the revised cash book or not, or the updated cash book or not, and two, if it going on the debit side or the credit side. So the first one, a check paid to a creditor of 1894 was entered in the cash book as 1984. That is an error in the cash book. So since it's an error that we made, do we have to correct it in our revised cash book?
Yes.
Yes. So let's see if we could correct this. If it was a check paid to the creditor, would it have been debited or credited? If we pay in a check,
Credited.
Credited.
credited. All right. So you're supposed to put 1894 on the credit side of our cash book. Instead, we put 1984. Did we put too much or too little?
Too much.
Too
Too much.
Little.
We put too much. It was supposed to be 1894, but we put 1984. That is more than what we were supposed to put, right? Because 1984 is more than 1894. How much more is it by?
100.
Use your calculator. That's happened every time I do this question. It's always say 100. At least
90.
one person has said 90.
90.
Right? You use all your calculators in all the exam. You're allowed to use it for paper 1 and paper 2. Use it, right? Just to avoid small errors. It's really easy to watch that and see 100. So we put 100 too much on the credit side. To fix this, what would we do? Will we debit or credit?
Debit.
Debit. If you have 100 too much on the credit side, to fix that, you would debit 100 to balance it off. So that is what we did. Start off with our balance brought down, and then we debit the cash book 90. The second one, direct credits received, so that's money we getting by the bank but not entered in the cash book, amounted to 500. Does this go in the revised cash book? Once it's in the bank statement but not in the cash book, it has to go into the revised cash book. So this was received by the bank but not entered in the cash book. Does this go in the revised cash book?
Yes, sir.
Yes. If it's money we receive, where would it be? Debited or credited?
Debited.
Debited. So we debit our cash book 500. Third one, bank charges not entered in the cash book. Would that be in the bank statement but not the cash book?
Yes, sir.
All right, what are we going to do? Debit or credit?
Debit.
Is it money we getting or money we spending?
Money we're spending. Credit.
Right, so credit, correct. A standing order of $36 for insurance premium was not entered into the cash book. Would this go in the revised cash book?
Yes, sir.
Debit or credit?
Credit.
Right, because we spending money. Next one, unpresented checks amounted to 6,936. Does this go in the revised cash book?
No, sir.
No. Unpresented checks are checks that we record, but the bank didn't. This goes in a bank statement, in a bank reconciliation statement. Unpresented checks and bank deposits, late bank deposits, go in a bank reconciliation statement. So the next one, bank deposits not credited by the bank. Would that go in the cash book, revised cash book?
No, sir.
No, that would be the late lodgement, right? So those two things will go in the bank reconciliation statement. And then the last one, checks returned to the bank marked refer to draw. What happened to the check? If it was marked refer to draw, it was a what
It was
kind of
this
check?
one.
A
It was this
dishonored
one.
check, right? It was not adjusted in the cash book. Would this go in a revised cash book?
Yes, sir.
It was not adjusted before, so now we have to adjust it. So when we got the check, we would have debited our cash book. Now that we know it's dishonored, what do we have to do?
We have to adjust it in our cash book.
By debiting or crediting?
Credit.
Crediting, correct. To take it out of our debit side, we'll have to credit it. So that is what we would do. And after we enter all of our transactions, we will balance it the same way we learned how to balance the accounts. We check to see which side is smaller. We go to the smaller side. For the last day of the month, details balance carried down. And the amount is the difference between both sides. I add up the bigger side minus the smaller side. I get my balance carried down. I put my totals. My totals should be equal. And then the first of the following month, that should be March. I don't know why you see in June. First of March, balance brought down would be 10,278. So now that I have my revised cash book balance, I can do my bank reconciliation statement now. So I start off with my revised cash book balance, and then I add something. Who remembers what you have to add?
350.
No, what you call it? Unpresented checks, elite lodgements, which one you adding?
Present.
Unpresented checks. So you start off with a revised cash book balance. You add unpresented checks, which is 6,936. And then what do you minus?
Late lodgement.
Your
Late
late
lodgement.
lodgement, which will be 548. So you start to revise cash flow balance, add unpresented checks, minus late lodgements, and that gives you a bank statement balance. And that is it. So just remember, when you're doing a bank reconciliation statement, you start off with your cash book balance, you add any unpresented checks, and you minus any late lodgements. Everybody good?
Yes, sir.
Mhm. So we'll stop here, and tomorrow we'll continue starting off with control accounts and then errors, and then we'll continue moving forward. All right, so we'll end here, and I will see you all tomorrow. Please, God.
Okay, sir.
Mhm.